Heineken may not be an exciting, fast-paced investment, but it may offer something different, something that in the long term may be even better than the next hot thing. It may offer a stable and secure way of gradually compounding our wealth. Let's see, is this the case? So Heineken Holding engages in brewing and selling beer and cider. The company's portfolio consists of approximately 300 brands. Just to name some of them, we have of course Heineken, but also Birra Moretti, Sol, Desperados or Kruszowice. And they recently published the 2023 half-year results. So the revenue went up by 6.3% in the last 6 months, but net profit went down by 8.6%. And as we can read in the report, in the second half of 2023, Heineken expects significantly improved operating profit. So these results are not very exciting, but they are only short-term results. So let's see the bigger picture and take a quick look at the history of this company. If you were to invest $1,000 into Heineken 10 years ago, you could buy around 15.6 shares, and today they would be worth around $1,266. So in 10 years you would gain 26.6%. Not bad, but not great either. But let's remember about the dividends. Through the 10 years you would receive $244 as dividends, and that is without reinvesting them. So if we add the current value of shares and the dividends, we get $1,510. So that is a 51% gain in 10 years. Quite nice. Maybe not exceptional, but nice. Individual insiders, that is an X. Only 0.3% of the company is owned by individual insiders. And we would like to see this number over 2%. But there is more to the story. Officially, we can find that individual insiders own 0.3%. But there is a holding company called L'Arche Green, and it owns 53.3% of Heineken Holding. And when we look inside this company, we see that 88.9% of it is owned by Heineken family and 11.1% by the Hoyer family. So in reality, Heineken Holding is a family business where two families own over 53% of the shares. And for me, that is very good news. This company is extremely important for people in charge. They have a legacy to think about. So hopefully we can expect some wise and responsible decisions from them. And are individual insiders buying? That is an X. In the last year, we don't see any transactions from insiders. And do super investors own Heineken? That is a check with 3 super investors, and they are Stephen Romick, Tweedy Brown Investment Fund, and Thomas Russo. And I made a video analyzing his portfolio, so if you want to check that out, you will find the link in the description and at the end of this video as well. And are super investors buying right now? That is a check. In the last 2 quarters, they bought almost 1,465,000 shares and sold only 48,000 shares. So a big commitment in the recent months. Return on invested capital. That is an X at 2.5% 10-year median returns. And we want to see this number higher than 10%. So such a return is quite disappointing. And free cash flow growth? That is an X as well, at 3.2% 10-year compound annual growth rate. So the growth is also very slow. And what do we know about net profit margin? It is another X at 4.6%, and the industry average is 5.7%. So they are not far off, but we don't see any great pricing power here either. And now let's take a look at share buyback. It is an X, but also it is a check. The number of shares in the last 10 years did not change. So they are not buying back shares, but also they are not diluting investors. So that's okay. And the debt, it is an X. It would take 4.3 years to pay the long-term debt with a current free cash flow. And we want to see this number under 2 years. So it's X's all around. That is not very encouraging at all, but maybe we can find something really good about this company when we look at the dividends. The dividend yield is 2.6%, and that is $2.09 annually. So nothing crazy, but decent. And payout ratio, that is a check at 38%. And we want to see the payout ratio somewhere between 20 and 50%. So that is nice. We are getting a fair share of the earnings, but at the same time, the company still has a lot of cash to grow the business. Speaking of which, what do we know about the dividend growth? It is a check at 3%. Again, nothing crazy, but it is a nice growth with some ups and downs since 2001. Price to earnings ratio is 15.6, and currently the S&P 500 average is 23.4. So this may be a nicely priced stock. But to properly value it, we will have to estimate the growth of Heineken for the next 10 years, and we will make 3 scenarios of this growth. So, in the low scenario, we will estimate a growth of 2% for the first 5 years and then 1%. In the medium, 3% and then 2%. And in the high scenario, 4% for the first 5 years and then 3% growth. Now, why did I use such estimates? Well, if we look at the 10-year annual growth rate, we see that the revenue went up by 2.3%, free cash flow by 3.2%, and earnings per share by 5%. So our estimates are a little bit conservative, but close to the historical results. And with such estimates, the intrinsic value in the low scenario is $94, in the medium $103, and in the high scenario $114. But we have to always add a margin of safety to those prices. I use a 30% one. And with such a margin we get, in the low scenario, $66, in the medium, $72, and in the high one, $79. And the current price is at $80. So all the prices without the margin of safety are in the green, but all the prices with the 30% margin of safety are in the red. But the difference in the high scenario is really small. So it may actually be the case that Heineken is being fairly valued currently. So we have here a family-run business that is paying a decent dividend and that is fairly priced. But at the same time, it is a slow grower and we should not expect this stock to skyrocket in the near future. It is a mature and stable business that may make sense as a long-term investment and a way to protect our money. But it most probably will not double your money in a short time. So it all depends on your style of investing. If owning such a company will make you sleep well at night, then maybe you should dig deeper into this company and consider it as an investment possibility. But if you are going to feel that you are missing out on some other more exciting possibilities, then this company is probably not for you. Thanks for watching and see you in the next one.